Islamic principles of halal and haram in investment. You know, you are making multiple investments, especially this topic is about stock market, right? So if you want to invest in stock market, so what are the issues and what are the matters you have to take into account? If, for example, if you want to invest in Emirates Airline, can you invest? That is a question.
Yes.
Or if you want to invest in a castle company, some haram product making company. So these things are discussed here. Over the period in the development process of modern Islamic financial system, certain efforts have been made to determine Sharia compliance status of companies listed on securities market. In this section, a study of Sharia screening filters has been conducted on a purposefully selected sample of institutions. Our sample includes 5 global recognized indexes with larger geographical coverage, including Dow Jones Islamic Market Index, S&P-Shari'ah Indexes, Morgan Stanley Capital International Islamic Index Series, Financial Times Series, Shari'ah Global Equity Index Series, and International Shari'ah Research Academy-Bloomberg. Shari'ah Research Academy and Bloomberg. In addition, the sample also includes 3 academic powerhouses in the area of Islamic finance: AAOIFI, KSE-Meezan Index, Pakistan, and Securities Commission Malaysia. So the context is this one, that there are stock markets, companies listed on those stock markets. But before you invest in a company on stock market, you have to check the Sharia compliance status of that company. And then you can make investment. And this checking Sharia compliance status is even applicable to companies who are engaged in halal business. If you want to invest in a cement company, or if you want to invest in a textile company, or if you want to invest in an airline company, you will check. It's not only about those companies who are doing haram business. Any company which is listed on Sharia on stock market, you will check the Sharia compliance status of that company. And we have specific test. You will apply those tests on the company. And if the company qualifies those tests, then you can invest in that company. So this is the context. Yani you are not free tomorrow, you go to the Dubai stock market and say, oh, give me the stock of this. So without checking whether it's a Sharia compliant company or not. So that is the point. So with the passage of time, certain efforts have been done, and globally it has become a norm that on stock markets, there are some organizations who create a list of Sharia compliant companies. So if you want to invest in a Sharia compliant company, you will find a ready-made list for the stock market. And some big companies, some big equity services providing companies like Dow Jones, like S&P, like Morgan Stanley, like FTSE, like Bloomberg. So they also provide list for different stock markets. And if you want to invest in any of those stock markets, so you can always look at the list provided by those agencies. We also have some country-specific indexes like for Pakistan and Malaysia. So if you want to invest in these markets, so there are country-specific Islamic indexes, and you can ask them for the list of Sharia compliant companies, and you will get that list. So instead of doing yourself this work, that whether this company is Sharia compliant or not, you can simply ask the relevant company, relevant authority to provide you the Sharia compliant list. And then you can make investment. So that is one thing. But you are a student of business, so you need to know that what they look for when they determine the status of a Sharia compliant company. So in this, we will try to introduce you that what are those specific elements which you take into account while you certify the Sharia compliance status of a company. So some preliminary things I want to make clear for you. For a company to be Sharia compliant, it is not required that all members or shareholders must be Muslim. You got this point? Yani it can be a company where Muslim, non-Muslim both share the ownership of the company. According to Accounting and Auditing Organization for Islamic Financial Institution, partnership in business is allowed with non-Muslims. And a modern corporation is a special form of partnership. In addition, there is no geographic restriction on the establishment of a company to be a Sharia compliant business. Yani it is not required that this company is formed in a Muslim country or not. Maybe it is formed in some non-Muslim country. Investment is allowed irrespective a company is formed and headquartered in a Muslim majority country or otherwise. In addition, there is no restriction whether such a company is formed under British common law or any other law to the best of author's knowledge. This is inferred based on prevailing practices of Islamic capital market, as company formation law is not included in filtration process, and companies formed in different jurisdictions, including non-Muslim countries, are included in Sharia compliant universes. However, this is an important aspect which needs attention of Sharia scholars and experts. So these are some preliminary matters about the company. Screening design. Institutions engaged in Sharia compliance process of stock market have agreed on two-tier filtration of constituents. Filtration means you have to pass the first step in order to go to the second step. First and foremost is checking Sharia compliance of core or principal activity of the underlying firm. Once a company is successful on business screening, then financial screens including the level of liquid assets, level of interest-based debts, level of interest-based investments, and tolerance limit for haram income are applied. By matching these Sharia compliance screens with principles stated above, we find them incomplete because a measuring tool for honoring contract, marketing and human resources policies, environmental damages, zakah payment and application of Sharia trading rules are missing. So this is a comment on existing criteria, but first we need to understand what is that criteria. Criteria is, first you look into whether this company is doing a halal business or haram business. So if it is doing halal business, you say first step qualified. If it is doing haram business, you say first step not qualified. The company which does not qualify first step, you don't go to the second tier of filtration. And second tier includes four things. One is that how much are your liquid assets? There is a limit for liquid assets. And second thing is how much loan you have taken on which you are paying interest. How much interest-based loan you are using in the business. And third thing is how much investments you have made into Sharia non-compliant businesses. What portion of your business is Sharia non-compliant? And finally, how much haram income is coming to your company? So these are the four tests which are coming into second stage of screening. And then, author has made a comment that although it's a good effort, but there are certain other things which are missing. And he has mentioned that maybe honoring contract, marketing and human resource, environmental damages, zakah payment and application of Sharia trading rules. One constraint being faced practically is the ownership of companies belong to both Muslims and non-Muslims, and certain expectation of Sharia compliance specific to Muslims, for example, payment of zakah in entirety from such companies might be too optimistic. Okay, so business activity screen. So when you are going to a stock market and you want to invest in a company, so first thing is you will apply a business activity screen. As far as business activity of investee is concerned, investee means the company whose share you want to buy. Activity of investee is concerned, there are very clear restrictions on investment. From Sharia considerations, companies are classified objectively in three categories as follows. So you will find three type of companies on stock market. First category includes corporation with business activities approved by Sharia. Companies who are doing halal business. Companies engaged in the provision of lawful needs and wants of consumers, including food, garment, furniture, education, and healthcare services, etc., etc., etc. So there is no problem. These companies qualify your first test. The second category includes corporations engaged in the operations disapproved by Sharia. Haram businesses. For example, companies engaged in production of liquor, pork, pornography, casinos, etc. So those companies gone straight away out. But there is a third category of companies. The third category includes companies partially engaged in permitted activities and partially in prohibited activities. For example, a cement manufacturer keep cash in a bank and receive interest from the bank. Or you have invested in, bonds, something like that. There are some other examples as well. For example, you are doing halal business and a portion of your business is, a portion is coming from haram sources as well. So these are third category of companies. So for category first, there is no problem. For category second, it doesn't belong to Islamic financial system. So they gone out. The rules which you will see later on, they are, this third category needs special attention of the experts. This third category. So let's see what is the position of this third category. There is a difference of opinion about Sharia compliance status of these companies. Third category. One group of experts do not consider these companies appropriate for halal investments. And this is, you can find the Islamic Fiqh Council, Muslim World League, during its 14th session held in Makkah Mukarramah on 20th Shaban 1415 Hijrah, 21st January 1995, decided the following. Third, it is unlawful for a Muslim to buy shares of companies and banks if some of their dealings are involved in usury and the buyer knows it. Available at Muslim World League. Link is given. You can access through this link the decision. Number one. Number two, Al-Munajid 2013 and Al-Usaimi 2005. They said, no, you can't do business with these, you cannot invest in these companies. So there is a difference of opinion. However, another group advocates investment in these companies if the contribution of haram segment is within a tolerable limit. And this comes from AAOIFI, Auditing, Accounting and Auditing Organization of Islamic Financial Institutions. Variations exist in screening process based on business activities of sample institutions. Certain business sectors are excluded entirely by some, while kept by others. However, no one has included any business sector which is engaged in haram activities as a core business. For example, conventional banks and conventional insurance companies and pork production companies and liquor manufacturing companies. So these type of companies, no one has included at all. Okay. So once you qualify the first stage, that the principal activity of the company is halal. Principal activity, yani your core business is halal business. But then certain portion of haram also comes in your business. So that is the point which you keep in mind. If your core business is haram, that company is not included. Core business must be halal, and how to deal with a small or little haram portion, that comes now in discussion. Look at this table. You just focus on first row only. First row. If you understand first row, rest will become very easy for you to understand. Just focus on first row at the top. So basically there are 4 tests. Your liquidity limit, yani your liquid assets should not be more than 70%. The investments you have made in haram avenues should not be more than 30%. The interest-based debt, if you have taken, it should not be more than 30%. And although they have given you too much concession in case of haram investment, up to 30%, and too much concession in case of interest-based debts up to 30%. But they have given you very small concession as far income is concerned. If your income is more than 5% coming from haram sources, your company will not qualify to the Sharia compliant companies list. So these are the 4 tests. So we understood these are the 4 tests. So first line is the test given by AAOIFI, Accounting and Auditing Organization of Islamic Financial Institution. Second line is given by FTSE-Shari'ah Global Equity Indexes. So you will find little bit difference. See, 5% is the same, 30% became 33%, another 30% became 33%, and 70% has reached to 83%. Then you have Dow Jones Islamic Indexes. It's 66% liquidity, 33% haram investment, 33% interest-based debt, and haram income is 5%. Then you have S&P, its liquidity is 82%, haram investment 33, interest-based 33, and haram income 5%. Then you have Morgan Stanley, its liquidity is 66, haram investment 33.3, interest-based debt 33.3, and haram income 5%. And then you have liquidity limit for International Sharia Research Academy and Bloomberg, the index which is made by these 2 organizations. About liquidity limit, they are silent. They don't say anything about liquidity limits. So for them, this is not a test. In case of haram investment, they are 33%. In case of interest-based debt, they are 33%. In case of haram income, they are 5%. Then you look at Securities Commission Malaysia. About liquidity limit, they are silent. They don't use this test. Haram investment 33%, interest-based debt 33%, haram income 5%, as well as 20%. So if you look at the explanation for this 5% and 20%, yeah, I will tell you later on that which are the incomes they say it should not be more than 5%, and which are the income they say it should not be more than 20%. Rest everyone has restricted within 5%, but they have categorized some income up to 5% and some income up to 20%. And then you have KSE-Meezan Index from Pakistan. So they say liquidity limit 75%, haram investment 33%, interest-based debts 37%, and haram income 5%. So by looking at this table, you noticed one thing, that there is a difference of opinion.
Doctor, like if one of them pass, like let's say they pass the liquidity limit, so they are haram, yes? Like if they pass only one, it's haram, khalas.
Yeah, you have to pass all four. So little bit difference is there, but we can see one thing is common in all screening agencies. That is, haram income is not more than 5%. And interest-based debt is not more than 33%, except in case of Pakistan, which is 37%. And haram investment is not more than 33%, except in case of AAOIFI, which is only 30%. By the way, AAOIFI also for interest-based debt is not allowing more than 30%. And liquidity limit is either there is not present, or the limit is very high. In case of FTSE, it is 83%, and in case of KSE-Meezan Index, it is 75%, and in case of AAOIFI, it is 70%. Okay, tell me one thing. The test which I am telling you, the tests which are written here, can you, I mean, these tests are given by Quran and Sunnah? Can you find a nas for these tests?
No.
Of course, no, you are right. So, for example, you are saying, oh, if a company is earning 5% haram, you can invest in that company, and that company will give you income. So that haram income will come to you as well. So these ulama says that 5% is the limit for investment. But any income which is coming to you out of this haram, haram earning, that is not halal for you. Keep this in mind. So there is another concept, we call it income purification. So for example, you have invested in a company, and that company gives you the dividend of 100. You received the income of 100, and the haram income of this company is 4%. It means out of 100, you got 4 dirham, which are from haram sources of income. So you have to give these 4 dirham in charity. We say this is your income purification. So although ulama has allowed you to invest in a company whose haram source of income is not more than 5%, but at the same time, ulama has said you cannot eat even a 1 dirham of haram income. Whatever income is coming to you, whatever profit is coming to you, whatever dividend is coming to you, and the haram source, the portion of haram source, you must give in charity, and we say this is your purification of income. Okay, so let's see what these liquidity limits are and how they are calculated, what these haram investments are and how they are calculated, what these interest-based debts are and how they are calculated. Another thing is, you are saying 70%, you are saying 30%, you are saying 5%. Of 5% of what? So 5% of total revenue. 30% of what? In this case, 30% of what? For example, if we talk about interest-based debt. So you see in the first line, there are 2 stars. In the second line, there is 1 star. Do you notice that? 2 star and 1 star. So there is an explanation for these 2 stars and 1 stars. If you look at the bottom of the table, what is meaning of 1 star?
Total assets.
And what is meaning of 2 stars?
Market capitalization.
Yeah, so have to take this, you have to take into account whether you are going to calculate on the basis of total assets, or are you going to calculate on the basis of market capitalization. That is the point. So this is again another difference of opinion and difference of application between multiple institutions. For example, in case of accounting and auditing organization, the liquidity limit is 1 star limit. Am I right? But the haram investment limit is 2-star limit. So that means you will calculate liquidity on the basis of total assets, and you will calculate haram investment on the basis of market capitalization. But if you look the case of KSE-Meezan Index, you have 1 stars. So that means in case of KSE, you will calculate liquidity on the basis of total assets, haram investments on the basis of total assets, and interest rate just on the basis of total assets. Likewise, Securities Commission Malaysia has 1 star. Morgan Stanley has 1 star, see? And FTSE has 1 star. And 2 stars are going to Accounting and Auditing Organization, Dow Jones Islamic Indexes, S&P-Shari'ah Indexes, and International Shari'ah Research Academy and Bloomberg. So these are taking into account market capitalization, and others are taking into account total assets. Very interesting. Asset structure. As per Islamic law, trading rules are different for absolute liquid items, including gold, silver, and currencies, as well as debts from general trading rules for commodities and assets. Cash and account receivable cannot be traded at a premium or discount. Keeping these rules in consideration, a limit has been imposed by Sharia boards of various Sharia screening agencies engaged in the preparation of Sharia compliant universe of companies. A review of the table suggests following important findings. Limit on liquid assets vary from 66% to 83%, although Apex standard setting body AAOIFI has set a limit of liquid assets up to 70%. In addition, Securities Commission Malaysia and ISRA-Bloomberg do not consider any cap on liquid assets appropriate in checking Sharia compliance status of a company. KMI has given an additional screen of market price to book value of net liquid assets should be greater than 1. So those assets which you cannot trade except at par, like cash and account receivable, the value of those assets must not be more than 70% as per AAOIFI, 75% as per KMI 30. And then different limits you saw in the table. So liquidity means, liquid assets means those assets which you cannot trade at a premium or discount, like cash and account receivables. As per Sharia Global Islamic, Sharia Global Index Series, account receivable limit is up to 49%, cash and interest-based investment limit is up to 33%. All those are monetary liquid assets because interest-based investments are a special form of receivables. Hence, effectively, liquidity limit reaches to 82%. Likewise, in case of Dow Jones Islamic Market Index, limit of account receivable is 33%, as well as limit of cash plus investment in interest-based securities are up to 33%, which leads to liquidity limit of up to 66%. Morgan Stanley International Islamic Index Series states that tolerance limit for account receivable plus cash is 33%, and tolerance limit for cash plus interest-bearing security is 33%. Assuming cash is 0, then tolerance limit of liquid asset effectively reaches to 66%. Test number 2, haram investment. The modern business environment is based on capitalism, market economy, and the prevailing norm is to sell whatever you can at a price, whatever you get. Market forces, demand and supply will determine the quantity required and the price established. There is no ethical filtration in many cases, except maybe on medical grounds. Under Islamic system, liberty is limited and activities are monitored through ethical filters. Keeping this principle in view, there are some activities in modern businesses which are declared haram by Sharia. For example, dealing in liquor, pork, casino, riba, and pornography. If a company is engaged in any prohibited activity as its core business, such company is out of Sharia compliant investment universe. However, there are companies with the core business of halal activities with some segment of haram operations too. For example, hotels and airlines, and are using conventional financial services. The purist approach is to refrain investment from such companies. However, there are advocates of investment in such companies with certain tolerance limits. The issue of investing in stock of companies with haram element in their activities is expected to be addressed partially with the maturity of Islamic financial system. Considering this issue, Sharia boards of various screening agencies have set a limit for haram investments by a company with core or principal activity in line with Sharia law. And you can see limits in the table 1. An examination of the table suggests that Sharia boards of some sample agencies engaged in Sharia compliance universe are unanimous on the figure of 1/3, yani 33%, except for AAOIFI where it is 30% instead. So this is context and explanation of, brief explanation of haram investments. Interest-based debts. One of the features of modern corporation is the overwhelming use of debt in financing their operations. Modern finance theory suggests the use of debt in optimal capital structure. The temptation to debts by corporation is because of 2 reasons. First, cost of debt is low as compared to the cost of equity, because from investors' perspective, debt instruments are less risky than equity instruments due to payment of fixed return irrespective of the outcome of the project financed through debt money, and preference in payment of interest and refund of capital to debt holders over equity holders. The second reason of the overwhelming use of debt is a tax benefit. Okay. Given the dominance of conventional financial system, firms use their financial services. From an equity investor's perspective, debt-based money used by a corporation results in generation of profit being shared with the investors. Tolerance limit ranges between 30% AAOIFI to 37% KMI, while the majority has focused on 1/3 of either total assets or market capitalization. Perhaps total asset base at book value or replacement cost is more relevant for the calculation of this ratio because debts are employed to finance assets and operations of the company in the hope to create value for investors. Haram income. Ideally, haram portion of income should be 0 for Sharia compliant businesses. However, given the widespread dominance of the conventional financial industry, firms have to use their financial services. Companies keep their idle funds and interest-based bank accounts as well as short-term marketable securities as part of liquidity management, resulting in the generation of some haram income. In addition, there are some companies with core business halal, but a portion of income is generated through haram sources. For example, air transportation and hospitality sector. Equity investment with certain tolerable limit is allowed in such companies as discussed in the previous section. Although investment in haram avenues is tolerated to a greater extent, majority screening services tolerate up to 1/3. However, the tolerance level of haram income set by Sharia boards of various agencies is very low. Except for Securities Commission Malaysia, all agree on 5% limit from prohibited activities. Securities Commission Malaysia agrees with others in case of haram income, however, generated another benchmark of up to 20% for doubtful activities, including hotel and resort operations, share trading, stockbroking business, rental received from Sharia non-compliant activities, and any other activity deemed non-compliant according to Sharia. So haram income must not be more than 5%. Income purification. As far as the contribution of haram sources up to 5% of total revenue tolerance limit is concerned, it is decided on the basis of need and negligibility, taking into account prevailing financial services environment dominated by conventional financial industry. And then author made a comment. We don't agree with using revenue as a base for calculation for reasons recorded in another section. However, an Islamic investor must purify the income earned from investment in such a by spending haram income for charitable purposes. Eating haram income is not allowed under any school of thought, including purists and others. Okay. So why these concessions are given? What is the appropriate tolerance limit of haram investments, application of interest-based debts and haram income for a corporation from Sharia consideration? There is nothing specified in original sources of Islamic law, Quran and Sunnah. Institutional settings of modern businesses are recent development in an era of colonization of Muslim societies. However, under an Islamic framework, doors for juristic opinion, ijtihad, remained open throughout the history. Purist approach would not allow investment in any of these companies on account of many questionable operations, including speculation and trading, prohibited means of marketing and sales, including partly in prohibited business activities, indulging partly in prohibited business activities, damaging environment through industrial pollution, involvement in riba, gharar, etc. However, a number of Sharia scholars support the idea of participation and competition in the modern world with certain restriction. This class of scholars allow investment in modern corporations and suggest these restrictions. Justification or basis for participation in the process are well recorded in AAOIFI 2015. The basis for exempting trading in the shares of these corporations whose primary activity is lawful. However, they deposit amounts and borrow on the basis of interest is the application of the rule of removal of hardship and acknowledging of general need, widespread practice, the acknowledged principles of surplus, shortage, and predominance, as well as the permissibility of dealing with one, the major part of whose wealth is lawful, along with reliance upon the issue of separation of bargains according to some jurists. This is upheld by most fatwa issuing organizations, as well as the Sharia supervisory boards of Islamic banks. So that is the stated reason for these concessions. It is pertinent to note that these concessions are provided by taking into account prevailing business environment, and by no way these are proven from Sharia law. Say again, it is pertinent to note that these concessions are provided by taking into account prevailing business environment, and by no way these are proven from Sharia law. Hence, tolerance limits should be based on need, rather than allowing the luxury of doing things repugnant to Islamic law under the umbrella of Sharia compliance. The next question would be, how much concession is needed to be considered genuine? So if these concessions are given on the basis of need, so how much is, justified? How much is genuine need? The correct answer would be, it may vary from jurisdiction to jurisdiction and firm to firm based upon institutional settings around. In certain countries, for example, Malaysia and Gulf region, the contribution of Islamic finance assets in total assets is higher as compared to other regions. Hence, tolerance limits should be different. However, for developing an upper limit, an analysis of existing practice in a particular market would be helpful to a greater extent, as it is done by Khat, Khati and Nishar on Indian market. They document that realistic limit based on needs would be debts to total assets less than 25%, investment in interest-based assets to total assets less than 10%, and interest to total income less than 3%. So this is the concluding remark for this investment thing. So if I recap what we have done, we started with that in order to invest in a company, we have to fulfill certain, we have to do certain tests, and passing of those tests is required by the company. So the first round of test or first level of test is to look into that what is the business of the company, and core business of the company must not be haram. This is number one. Then we move to the second stage, and in second stage we look at four things. Number one, how much you have liquid assets, and liquid assets includes those assets which cannot be sold at discount or premium, like currency and accounts receivable. So we find some limits for these liquid assets, and they vary from organization to organization. Actually, the limit is this one. For AAOIFI, it is 70%. For FTSE, effectively 83%. For Dow Jones, effectively 83%. For S&P-Shari'ah indexes, effectively 82%. For Morgan Stanley, effectively 66%. For international, for ISRA-Bloomberg, no limit. For Securities Commission Malaysia index, no limit. For Pakistani index, it is 75%. The second thing was how much your investment is in the haram business sector, haram investments. And we find a range of 30 to 33%. In fact, all are 33%, except the AAOIFI, Accounting and Auditing Organization. They say it should not be more than 30%. Then we switch to interest-based debts, that, okay, you are doing a halal business, but at the same time, you are using the conventional finance and you have taken the loan. So limit is set up to starting from 30% and ending at 37%. The strict limit is given by the AAOIFI, that is 30%. And higher limit is given by the Pakistani stock index, which is 37%. The rest, almost everyone is at 33%. And finally, we came to the point that the company to whom we are investing, how much haram income is coming to that company? How much is the portion of income which is earned through haram sources? So here, they have very much, they have shown very much, conservatism, and none of the index allows you the income, haram income, more than 5%, except in case of Securities Commission Malaysia, that some sectors they have included up to 20%, but in other sectors they are with the overall explanation. So interesting thing is that these different screening bodies, they have agreed on 5% of haram income. So it would be good if they agree on the other limits as well. For example, if they agree on interest-based debts, if they agree on haram investments, if they agree on liquidity limit, that would be a great standardization of the products of Islamic financial system globally. But so far, this difference exists. And finally, we look at that why these concessions? Do we find these concessions in Quran and Sunnah? Of course, no. So then what is the justification of these concessions? And justification is the, as presented by AAOIFI, that the justification is this one: the basis of exempting trading in the shares of these corporations, whose primary activity is lawful, however, they deposit amounts and borrow on the basis of interest, is the application of the rule of removal of hardship and acknowledging of general need, widespread practice, the acknowledged principle of surplus, shortage, and predominance, as well as the permissibility of dealing with one, the major part of whose wealth is lawful, along with reliance upon the issue of separation of bargains according to some jurists. This is upheld by most fatwa issuing organizations as well as the Sharia supervisory boards of Islamic banks. And our final comment is that instead of having, across the board 37 for example, if you talk about Dow Jones Islamic Index, so they said this one is, this one is this percent, this one is 33%, this one is 5%, this one. Because you are giving these concessions on the basis of need, so maybe you need to look into the market where you are doing these things. Maybe such limits are not, excessive limits are required in the countries where you have more Islamic banking as compared to those countries where you have less Islamic banking. So this was our final comment.